Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering BlackRock. BlackRock fires over 600 people as the ESG scam collapses. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Coming from the New York Post, BlackRock plans to lay off 600 employees, about 3% of its global workforce. On Twitter from Unusual Whales, a great finance account, BlackRock is reported to lay off approximately 600 employees, mainly from their ESG division per Fox Business. From the Hill, the rise and fall of ESG investing. People have started to really discover that ESG, DEI, it's all a complete fraud. It's a complete scam. And don't just take my word for it. From Bloomberg.com, under their green section, world's #1 ESG fund class ratchets up exposure to oil and gas. Fossil fuel holdings rose after stricter ESG rules enforced. Literally, ESG funds that are supposed to be promoting green energy strategies, sustainability and development, diversity, equity and inclusion, free energy. Who knows what they're trying to push? But it's not supposed to be oil and gas. The world's biggest ESG fund class, which sits on roughly $5 trillion of assets, has raised its exposure, which means it's bought more of the oil and gas sector by about 2/3 since stricter regulations were enforced 2.5 years ago. So funds promoting environmental, social, and good governance metrics had about 2.3% of their holdings in fossil fuel assets at the end of the third quarter, up from 1.4% right after Europe introduced a framework for ESG investing in 2021. So they tell you they need to push these social changes and that this is what's going to be good for the future. And by the way, we'll just take over acting as if we're your government, but they're still investing in fossil fuel anyway? What a scam. Also from Bloomberg.com, BlackRock sued by Tennessee over misleading ESG strategy. The state claims BlackRock breaches consumer protection laws. How could they possibly breach consumer protection laws? The lawsuit explains. Tennessee sued BlackRock Incorporated for allegedly breaching consumer protection laws by making misleading statements about its ESG investment strategy. State Attorney General Jonathan Skrmetti said BlackRock funds that don't take into account ESG factors are being unfairly impacted by the asset manager's membership in climate groups, its shareholder voting record, and the pressure it puts on companies to meet environmental goals, according to a complaint filed in the state of Tennessee. This shows a pattern of deception that has hurt investors, according to the complaint. But that's not all. Also from Bloomberg Law, antitrust enforcers differ on whether ESG collaboration is collusion. Now check this out. Companies working together on what they call ESG goals, and that's supposed to protect them from illegal coordination. There's a reason why companies aren't supposed to collaborate on things like pricing and strategies, because they do it to their own benefit at the expense of their customers. It's like antitrust, anti-price fixing, and anti-monopolistic behavior. Agreements between industry competitors and sharing competitively sensitive information in the name of promoting an environmental, social, and governance initiative are likely to draw concern from antitrust agencies, no matter the jurisdiction or how good the intention. Although U.S. antitrust enforcers have shed little light on the parameters that separate legitimate ESG collaboration from improper collusion, some jurisdictions have provided specific guidelines for ESG collaboration. There's a U.S. approach, an EU approach, a UK approach. Just calling something ESG when you're actually making investments in fossil fuels, when you're actually collaborating with your competitors at the disadvantage of your customers, it's not going to protect these companies. And from the New York Post, BlackRock is laying people off. BlackRock, the world's largest money management firm, plans to announce layoffs in the coming days of about 3% of its global workforce. The job cuts of around 600 employees, which have yet to be reported, are being described internally as routine. Last year, BlackRock did a similar round of layoffs gauged on employee performance metrics. Shares of BlackRock were down 21% in 2022. They came back another 6%. They're up a little bit in 2023, but still down. A possible impetus for the layoffs after years of wild growth in assets under management. So this is assets that they would take in from governments, from large investors to manage people's money to give them a good return on their investment, is settling into a more mature phase in its business. So it's not growing anymore. analyst consensus for its earnings in its fourth quarter projects a 2.46% decline year over year to $8.71 per share. BlackRock finished the third quarter of 2023 with $9 trillion in assets under management, which is actually a lot of money. However, they had $10 trillion in assets under management in 2022. That's $1 trillion less a year to manage. The decline in assets came as BlackRock became a political lightning rod over its ridiculous excessive pushing of environmental social governance investing, ESG, which directs investment dollars into public companies in the sustainable energy space, unless you're actually just putting it into fossil fuels, as we saw from the Bloomberg article, or those that are taking steps to reduce their carbon footprint and advocate corporate governance measures such as boardroom diversity and all of diversity, equity, and inclusion. And the result is layoffs and losing $1 trillion of investor money that they can make their own percentages off of by managing it. The firm has been de-emphasizing its ESG business in the United States amid controversy. Fox Business learned U.S. portfolio managers are no longer required to consider ESG metrics when not using ESG funds. And that means when they're making investments, they don't consider ESG in everyday investments, only in investments that are specifically marked to be for ESG investments. So when they're buying oil and gas through their ESG fund and some other wacky solar stocks or whatever else they're doing, those would still require them to put on ESG metrics and judge the investment to be ESG related, but they're not doing it anymore with normal companies that are not part of their ESG investment strategy. In 2023, many so-called green investment funds have seen declines in assets amid weak performance as investments in sustainable energy products fail to produce significant returns. The ESG scam is getting completely exposed. They used to be able to charge more money just by calling it an ESG investment to their clients. So by saying, hey, I'm going to invest some money for you in ESG, I'm going to have to charge you a little extra for that. Is that okay? They just do it. They get away with it, but not so much anymore. Company founder and CEO Larry Fink told Fox Business he won't use the letters ESG any longer because of the controversy he stirred up in political circles. As top Republicans, including several running for the GOP presidential nomination, have attacked BlackRock and ESG, those running pension funds in red states have yanked around $6 billion from BlackRock funds as a form of protest. People close to BlackRock tell Fox Business that savings from the job cuts will be used to expand into growth businesses, such as technology investing and investing in so-called alternative products as opposed to stocks and bonds. ESG, meanwhile, remains a big business with BlackRock's foreign customers, including large sovereign wealth funds in Europe and the Middle East. Mark Wiedman, head of BlackRock's client business, speaking at a recent event sponsored by the news outlet Semaphore, called ESG, quote, a demand from clients with around $1 trillion in pure sustainable assets being managed by BlackRock. But things have gotten so bad that the Harvard Business Review is writing article after article trying to tell people, listen, don't give up on ESG if you run a company. This is from Harvard Business Review. This was just back in April. Why business leaders must resist the anti-ESG movement. And more recently in December from Harvard Business Review, ESG is under attack. How should your company respond? And they then go through this lengthy explanation of how to identify each of the different constituencies that are upset with ESG and what you can try to tell them to work around them. Because it's now been common that if you're pushing ESG and DEI at companies, you're getting backlash. He goes on to identify vested traditionalists' ESG focus in bad faith. For some, the rise of ESG funds is a threat. They don't want to see the world use the leverage of finance and reporting to address shared challenges. It would reduce their power. This is mainly two groups. One, fossil fuel companies, which we've already seen they're actually investing in fossil fuel companies through ESG funds, as well as some traditional investors steeped in shareholder primacy, meaning traditional investors that say, wait a minute, I'm giving you money to invest in stocks for the benefit of the stock going up in value. That's the primacy. Focus on the value of the stock. And what he calls an obsession with short-term profits. Like, yep, you expect a return on your investment. In some cases, of course, if you're retiring on a pension, if there's no return on that investment, you're not going to have money. And he claims that people also don't care if ESG makes sense. Well, people do care, and it doesn't make sense. These groups want to continue making money the way they know how, rather than some risky strategy that actually doesn't work. If ESG would make money for people, BlackRock would not be laying off 600 people in an ESG department. They would be growing their ESG department. They wouldn't have $9 trillion to manage in 2023 versus $10 trillion in 2022. Because money always attracts more money. And yes, if you make more money, you even have more money to invest. BlackRock should be managing more money as the years go on, not less money. People are not happy with them, and the ESG strategy is obviously not working. And so here's how he suggests handling the people that are traditional investors that just want an actual cash return on their investment rather than promoting DEI and ESG. Companies will feel pressure from these groups through industry organizations and value chains, or through their investor base. If sustainability is a priority to your business, then the larger play is to change the mix of investors. So just get rid of your investors that care about getting a return on investment. Seek out those with a longer-term view, people that won't hold you accountable, such as institutional investors. Institutional investors are big money investors. Institutional investors are a company or an organization that invests money on behalf of clients or members. So individual investors don't really get that much of a say. The money goes to the institutional investor who then makes the decisions of what to invest in. That's why the BlackRock people, the ESG people, like institutional investors so much. Hedge funds, mutual funds, and endowments are examples of institutional investors. Now, while you follow this author's advice and get rid of the investors that don't want to let you waste money on ESG, he suggests to keep making the business case for action on environmental and social challenges. You may convert some of those people to see that over time, sustainability and business value are interdependent, not at odds. None of that has been proven. None of what they've suggested about ESG has ever been proven to be true. Like, just give me 5 years, 10 years, 20 years, 50 years. It's all going to work out. No, it isn't. With industry peers and partners who cast doubt, stick to your guns about what you expect from them. It was only a matter of time before ESG and DEI started to fall apart in public. It's going to continue to fall apart over 2024. Of course, I'm going to continue to cover it enthusiastically on this channel as DEI and ESG gets wiped off the face of the earth. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.